Palantir 93% revenue growth. Is your AI strategy already obsolete? Palantir's 93% Q2 revenue growth proves why you must build a robust AI strategy to protect and strengthen enterprise value. Palantir's reported 93% Q2 revenue growth, $1.94 billion quarterly revenue, 41 cents adjusted EPS, 149% U.S. commercial revenue growth, and a 12% stock surge should make you question whether your own AI strategy is creating measurable enterprise value or simply consuming capital. You should recognize that Palantir's raised full-year revenue guidance of approximately $8.15 billion signals sustained enterprise demand. Yet history reminds you that many technology booms, from the 2000 era onward, reward disciplined execution far more than optimistic forecasts. When quarterly net income approaches $1.07 billion, while commercial customers continue expanding deployments, you should see proof that executives increasingly prioritize operational ROI over AI experimentation, because businesses ultimately measure performance through cash generation instead of technological excitement. Enterprise AI is rapidly shifting beyond isolated chatbots toward integrated operating platforms, yet you should remember that every major technology wave, including cloud computing over the last 20 years, rewarded organizations that invested equally in governance and operational discipline. Palantir's commercial momentum demonstrates growing confidence in secure enterprise data environments, but you should avoid assuming every vendor can replicate success, because over 2 decades of platform development cannot be compressed into a few quarters of aggressive AI spending. L-Impact Solutions believes the impressive 93% revenue growth, 149% commercial expansion, 47.1% operating margin, and $1.22 billion free cash flow deserve admiration, but they should never persuade you to suspend rigorous investment discipline or strategic skepticism. Global enterprise AI investment exceeding $390 billion in 2026, alongside hyperscalers investing more than $350 billion annually, proves that money alone rarely guarantees competitive advantage, because many expensive transformation programs still fail before reaching enterprise-wide deployment. The article reminds you that many AI initiatives never progress beyond pilot stages because organizations frequently underestimate data quality, executive ownership, governance maturity, and measurable business objectives, despite investing billions across increasingly complex digital transformation programs. Palantir signing approximately $3.37 billion in quarterly contracts reflects remarkable commercial confidence, yet you should remember that future growth still depends upon sustained enterprise capital expenditure, favorable economic conditions, and continued executive willingness to prioritize AI investments. Concentrating mission-critical operations within one AI ecosystem may initially simplify implementation, but you should question whether higher switching costs, vendor lock-in, cybersecurity exposure, and integration complexity could become strategic liabilities over the next 5 to 10 years. Companies maintaining growth above 90% annually eventually confront exceptionally difficult comparisons, meaning investors increasingly evaluate future execution against elevated expectations instead of historical achievements, making valuation compression a realistic possibility despite operational excellence. When Satya Nadella describes AI as the most transformative technology of our time, you should hear both opportunity and responsibility, because every major industrial transformation historically rewarded organizations capable of executing consistently under increasing operational complexity. Jensen Huang's observation that buying more computing power reduces unit economics should never convince you that infrastructure spending automatically creates enterprise profitability, because business economics ultimately depend upon measurable returns rather than hardware acquisition alone. Alex Karp's emphasis on AI sovereignty should encourage you to protect proprietary knowledge, because ownership of enterprise data increasingly determines competitive resilience, especially as regulatory scrutiny and cybersecurity threats continue expanding across global digital economies. Instead of selecting fashionable AI platforms first, you should define measurable commercial objectives such as 5 to 15% operating cost reduction, 10 to 25% productivity improvement, or 15 to 30% forecasting accuracy improvement, ensuring technology remains accountable to financial performance. Every enterprise AI investment should justify itself through inventory optimization, fraud reduction, predictive maintenance, customer retention, and working capital efficiency, because sustainable shareholder value has historically emerged from operational excellence rather than technological novelty alone. Data governance deserves funding equal to AI software because poor quality information quietly destroys executive decision-making. While organizations targeting 98 to 99% structured data accuracy significantly improve forecasting reliability, compliance readiness, and enterprise operational resilience. Board oversight should become mandatory whenever AI investments exceed predefined capital thresholds because cybersecurity, financial exposure, legal compliance, ethical considerations, and operational resilience deserve executive scrutiny before organizations commit increasingly larger strategic budgets. Quarterly executive dashboards should continuously evaluate AI adoption, productivity improvement, financial returns, cybersecurity incidents, model accuracy, customer satisfaction, and business continuity, because what executives consistently measure generally becomes what organizations continuously improve. L-Impact Solutions encourages you to diversify technology architecture across multiple cloud providers, private infrastructure, open source models, and evolving foundation models because strategic flexibility consistently strengthens negotiating power while reducing long-term operational dependence on single vendors. Rather than committing enterprise-wide AI budgets immediately, you should begin with 3 to 5 high-impact business processes, evaluate measurable improvements over 90 to 180 days, and expand only after documented ROI comfortably exceeds predetermined financial thresholds. Organizations allocating approximately 15 to 20% of total AI budgets toward workforce capability development generally strengthen implementation quality because employees who understand governance, cybersecurity, and workflow redesign become critical drivers of sustainable transformation success. Cybersecurity investment should expand alongside AI adoption because rapidly growing API integrations, cloud platforms, IoT devices, and third-party ecosystems dramatically increase attack surfaces, making zero trust, encryption, and continuous validation increasingly indispensable. Michael Porter's advice about choosing what not to do remains remarkably relevant because organizations frequently create unnecessary operational complexity by deploying AI everywhere instead of concentrating resources on financially meaningful strategic priorities. You should establish enterprise AI governance before expanding into finance, manufacturing, healthcare, logistics, customer service, or strategic planning because prevention consistently costs less than correcting widespread operational failures after large-scale deployment begins. AI readiness assessments examining infrastructure scalability, cybersecurity posture, cloud dependency, workforce capability, financial resilience, vendor concentration, and regulatory exposure help you identify hidden implementation weaknesses before they become expensive enterprise-wide disruptions. As AI increasingly connects APIs, digital twins, enterprise software, cloud environments, and IoT ecosystems, you should strengthen privileged access management, multi-factor authentication, annual penetration testing, and continuous threat monitoring before attackers exploit expanding vulnerabilities. Scenario planning should become a board-level discipline because modeling regulatory changes, geopolitical instability, infrastructure outages, cyber attacks, supplier concentration, and economic downturns prepares you to make faster decisions when unexpected crises inevitably emerge. L-Impact Solutions recommends evaluating every technology vendor beyond software capability by examining financial stability, interoperability, customer concentration, cybersecurity maturity, contractual flexibility, disaster recovery readiness, and long-term commercial resilience before approving strategic procurement decisions. Jeff Bezos warned that failing to evolve creates the greatest danger, yet you should remember that sustainable AI leadership depends less on rapid deployment and more on disciplined governance, resilient architecture, measurable ROI, diversified partnerships, and continuous organizational learning. Continuous executive dashboards should replace traditional quarterly reporting because monitoring AI utilization, operational efficiency, cybersecurity incidents, productivity gains, revenue contribution, customer satisfaction, and return on invested capital enables faster intervention before small performance gaps become major financial problems. Jeff Bezos famously argued that failing to evolve creates the greatest danger. Yet you should remember that history shows countless technology leaders disappeared because they expanded recklessly instead of building disciplined governance around innovation and capital allocation. Palantir's approximately $1.22 billion quarterly free cash flow demonstrates that profitable AI businesses generate financial flexibility, but you should question whether your organization measures cash generation with equal intensity instead of celebrating isolated technology milestones. The company's combination of $1.94 billion quarterly revenue, nearly $1.07 billion profit, and 47.1% operating margin proves execution matters. Yet you should never assume extraordinary financial performance permanently protects businesses from future competitive disruption. Every technology cycle eventually rewards disciplined operators over enthusiastic adopters. So you should ask whether your AI roadmap contains measurable governance, financial accountability, and resilience rather than simply chasing the industry's fastest-growing platforms. L-Impact Solutions reminds you that enterprise AI success is ultimately measured through stronger margins, healthier cash flow, resilient operations, and sustainable shareholder value, because impressive software demonstrations rarely compensate for weak business execution or governance failures. Enterprise leaders should recognize that AI adoption without clean data resembles constructing skyscrapers on unstable foundations, because even sophisticated algorithms cannot consistently overcome inaccurate information, fragmented databases, duplicated records, or inconsistent operational governance. Global enterprises collectively investing over $390 billion annually into AI should encourage ambition. But you should remain cautious because previous technology revolutions repeatedly demonstrated that capital intensity alone rarely guarantees durable competitive differentiation or profitable transformation. Hyperscale providers spending more than $350 billion every year reinforce infrastructure confidence. Yet you should remember that enterprise competitiveness ultimately depends upon execution quality, leadership capability, operational redesign, and disciplined financial management instead of infrastructure ownership. You should never confuse AI procurement with AI transformation because genuine enterprise value emerges only when governance, workforce capability, cybersecurity, executive accountability, and measurable commercial outcomes evolve together across the organization. Organizations frequently underestimate the hidden costs of vendor lock-in, including contract renegotiations, migration complexity, cybersecurity exposure, and innovation limitations, making technology diversification an increasingly valuable strategic safeguard as AI ecosystems continue consolidating globally. Historical enterprise software markets repeatedly demonstrated that dominant vendors eventually face disruption. So you should prioritize interoperable architectures capable of adapting across multiple platforms rather than becoming permanently dependent upon a single commercial ecosystem. AI sovereignty is rapidly becoming a competitive differentiator because organizations protecting proprietary data, intellectual property, and operational knowledge increasingly strengthen negotiating leverage while reducing dependence on external platforms controlling critical business intelligence. Executive teams should evaluate every AI proposal using financial metrics including operating margin improvement, capital efficiency, revenue contribution, return on invested capital, and productivity enhancement because technology initiatives deserve the same investment scrutiny as acquisitions or expansion projects. The article consistently argues that governance should always precede automation, reminding you that even breakthrough technologies create long-term shareholder value only when disciplined leadership transforms innovation into repeatable operational capability rather than experimental enthusiasm. L-Impact Solutions encourages you to challenge every AI investment by asking whether it genuinely strengthens resilience, improves financial performance, reduces operational risk, and enhances long-term enterprise competitiveness instead of merely following rapidly changing market narratives. You should remember that AI implementation is not a one-time technology purchase because continuous model validation, cybersecurity upgrades, regulatory adaptation, employee training, and executive oversight determine whether transformation remains sustainable over many years. Companies delaying governance until after deployment frequently encounter expensive compliance failures, operational disruptions, and cybersecurity incidents, proving that prevention consistently delivers stronger financial outcomes than reactive correction once enterprise-wide AI dependence has already developed. Sustainable competitive advantage increasingly belongs to organizations converting AI into enterprise operating capability because operational consistency, disciplined execution, and measurable financial outcomes remain significantly harder for competitors to replicate than software licenses alone. Investors celebrating rapid revenue expansion should simultaneously examine valuation discipline because financial markets historically reward exceptional growth until expectations exceed operational delivery, often triggering substantial corrections despite fundamentally healthy businesses continuing to expand. You should view Palantir's remarkable quarter as evidence that enterprise AI demand is accelerating, but never interpret one company's extraordinary success as proof that every AI investment automatically deserves unlimited executive confidence or shareholder capital. AI transformation succeeds when boards actively supervise financial exposure, cybersecurity readiness, ethical oversight, legal compliance, operational resilience, and measurable performance because executive accountability consistently strengthens long-term implementation quality across increasingly complex enterprise environments. The strongest organizations continuously balance innovation with discipline because history repeatedly demonstrates that companies surviving multiple technology revolutions typically prioritize resilient governance, prudent capital allocation, and strategic adaptability over aggressive expansion alone. Enterprise resilience increasingly depends upon diversified technology partnerships because relying exclusively on one platform exposes businesses to pricing changes, regulatory uncertainty, service disruptions, geopolitical pressures, and evolving cybersecurity threats capable of affecting long-term competitiveness. L-Impact Solutions believes your AI strategy should be judged less by implementation speed and more by measurable productivity, stronger profitability, improved governance, enhanced cybersecurity, disciplined investment decisions, and sustainable enterprise resilience over the coming decade. You should continuously compare AI investment outcomes against predefined financial thresholds because disciplined measurement protects organizations from emotional decision-making while ensuring scarce capital consistently flows toward initiatives generating verifiable commercial value and operational improvement. Palantir's 93% revenue growth, 149% U.S. commercial expansion, approximately $3.37 billion contract value, and $8.15 billion annual guidance collectively demonstrate execution excellence. Yet disciplined governance remains the more durable competitive advantage highlighted throughout this analysis. The broader message extends well beyond one technology company because enterprise AI will ultimately reward leaders who consistently balance innovation, governance, cybersecurity, workforce capability, financial discipline, and measurable business outcomes across every operational function. Every executive should recognize that technology leadership is earned through disciplined execution rather than optimistic projections, because sustainable shareholder value consistently emerges from resilient operating models supported by accountable governance, trusted data, and evidence-based investment decisions. The real lesson is not whether Palantir outperformed expectations, but whether you are prepared to transform AI into measurable enterprise value before competitors convert disciplined governance and strategic execution into irreversible long-term market leadership. Is your AI strategy creating enterprise value or just expensive hype? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.